Three private companies are grading every American adult right now. Not the government, not the banks. Three corporations you never agreed to do business with. They decide if you get an apartment, a job, a car loan, a mortgage, the rate on your insurance. You cannot opt out. You cannot leave their database. You cannot choose to be ungraded. This is the story of how three companies built a private surveillance system over American financial life, and why nothing has been done to stop them. Their names are Equifax, Experian, TransUnion. Together they hold credit files on more than 200 million American adults. 90% of all lenders in the United States use them. When you apply for an apartment, the landlord pays one of them for a report on you. When you apply for a job, the employer may pay one of them for a report on you. When you buy a car, when you apply for insurance, when you sign up for a phone plan, somewhere in that transaction, money flows to one of these three companies. In exchange, they hand over a file on you. You did not sign anything authorizing this. You did not choose to be in their system. The system existed before you were born and will exist after you die. At the center of that file is a number, a score, calculated by formulas the companies will not fully disclose, updated by data sources you cannot fully audit, disputed through a process the federal government has called shoddy and unresponsive. That number decides what life is available to you. To understand what these companies are, look at the oldest one. Equifax was founded in 1899 in Atlanta, Georgia, by two brothers named Cater and Guy Wolford. It was not originally called Equifax. It was called the Retail Credit Company. The Retail Credit Company went door to door in American neighborhoods. They asked merchants for information about their customers. They wrote down what they were told. The ledger entries were not just about whether someone paid their bills. The ledgers included notes on political activity, on religious beliefs, on marital problems, on race, on what the investigators called moral character. Businesses paid the Retail Credit Company for that information. In 1970, the federal government found out what the company had been doing. Congress held hearings. Witnesses testified that the Retail Credit Company had been rating employees of their business clients based on how much negative information could be found about them. The company denied that the findings were used in credit decisions, only in insurance and other investigations. Congress passed the Fair Credit Reporting Act that same year. For the first time in 71 years of operation, the Retail Credit Company was required to let consumers see what was written about them. 6 years later, the company changed its name. Retail Credit Company became Equifax. The new name was cleaner. The database was the same. In May 2017, criminals exploited a vulnerability in an Equifax website application. The vulnerability had a patch available. The Department of Homeland Security had notified Equifax about it 2 months earlier. Equifax had not installed the patch. For 76 days, the criminals had access to the company's files. By the time the breach was discovered, the personal information of approximately 147 million Americans had been stolen. Names, dates of birth, social security numbers, driver's license numbers, addresses, in some cases, credit card numbers. This was nearly half the population of the United States. A private company had collected this information without consumers' explicit consent. The company had failed to protect it. The information was now in criminal hands. In the days before the public disclosure, 3 Equifax executives sold $1.8 million worth of their personal Equifax stock. The Securities and Exchange Commission investigated. The Department of Justice investigated. Only one of the 3 was ultimately charged. He pleaded guilty to insider trading and served 4 months in prison. In 2019, Equifax reached a settlement with the Federal Trade Commission, the Consumer Financial Protection Bureau, and 48 states. The company agreed to pay up to $700 million. That same quarter, Equifax reported revenue of $880 million. The settlement was less than 1/4 of revenue from the company that had failed to protect 147 million people's data. If this is the kind of pattern you want to see exposed every Thursday, hit subscribe. When a credit file contains an error, the consumer's only recourse is to file a dispute with the credit bureau. Federal law requires the bureau to investigate the dispute within 30 days. Between 2019 and 2021, a congressional investigation found that the three major credit bureaus had discarded at least 13.8 million consumer disputes without investigating them. The investigation examined how each bureau decided which disputes to discard. Equifax internal guidelines instructed staff to disregard mail that tends to use identical language and format and come from the same zip code. Experian discarded disputes based on what it called envelope characteristics, letter characteristics, same or similar ink color, same or similar font, same or similar verbiage. TransUnion used a written reference guide for disregarding disputes based on envelope-related criteria. The bureaus argued they were trying to identify illegitimate disputes filed by credit repair companies, but the investigation found that the criteria were vague and speculative. The result was that millions of legitimate consumer disputes filed by Americans trying to correct real errors on their credit reports were thrown out without investigation. The Congressional Subcommittee called for the Consumer Financial Protection Bureau to investigate whether this constituted a violation of the Fair Credit Reporting Act. In December 2024, the Consumer Financial Protection Bureau proposed a rule. The rule would have extended the Fair Credit Reporting Act to cover data brokers. It would have required separate explicit consent before a person's credit report, including their social security number, income, and financial history, could be sold or shared. The proposed rule was the first major attempt to close what investigators had called the credit header loophole, the mechanism that allows credit bureaus to sell consumer information to third parties without consumers being told. In May 2025, the Consumer Financial Protection Bureau withdrew the rule. The agency stated that the rule was no longer necessary or appropriate. The withdrawal happened by quiet notice in the Federal Register. More than 600 public comments had been submitted in support of the rule. They were not part of the published reasoning for withdrawing it. What this meant in practice: the data broker industry, which purchases sensitive financial information from credit bureaus and resells it to scammers, stalkers, debt collectors, and foreign intelligence services, would continue to operate without consent requirements. The protective rule died. The selling continued. Why does the system continue this way? The answer is the same answer that explains most of what the Dark Vault investigates: money. Equifax reported revenue of $5.7 billion in 2023. Its market value as of recent trading is over $30 billion. Experian, headquartered in Dublin, Ireland, reports global revenue of more than $7 billion annually. TransUnion reports annual revenue around $4 billion. Together, the three companies generate more than $15 billion a year by holding files on people who never agreed to be in their system. The Equifax stock price recovered from the breach within 4 years. The company today is worth more than it was the day before the breach was disclosed. The CEO at the time of the breach retired with a severance package. The new leadership team is similar to the old leadership team. The database is the same. The dispute discarding patterns continue. The data broker sales continue. And every American adult continues to be graded by a number they did not consent to, calculated by formulas they cannot see, generated from data they cannot fully audit, sold to parties they cannot identify. The defenders of this system argue that credit reporting makes the economy work, that without a centralized record of how Americans handle debt, lenders would be flying blind and ordinary consumers could not get loans. Some of that is true. A credit system has functions worth preserving, but that is not the system that exists. What exists is a private surveillance industry, started in the 1890s to rate Americans on race and political views, expanded over a century into a database covering nearly every adult in the country, breached in 2017, with consequences less than 1/4 of revenue, sued for discarding millions of consumer disputes, and freed in 2025 from new federal rules that would have required consent. 3 private companies hold the file. 90% of lenders use it. There is no opt-out. There is no alternative. The Fair Credit Reporting Act of 1970 was the first attempt to regulate this industry. More than 50 years later, the regulation has not kept up with what the industry became, and the Americans being graded, the ones generating the data, are paying for it with their privacy, with their access to housing, with their access to jobs, with their access to their own financial lives.